Although it rebounded very slightly today to close at 12.11, the VIX index is at a very low level relative to its own history over the last 5 years. We'll talk about that and take your questions today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic. The VIX index closed below 12 last Friday. That was the first time it did that since 2019. And even in 2019, it touched levels below 12 on only 3 trading days, the Monday, Tuesday, and Wednesday before Thanksgiving that year. Not only a relatively quiet time for the market, but also due to the way the VIX is calculated, it can be depressed when the following 30 days incorporate holidays. Just as a little bit of background, the VIX index is a financial benchmark that is designed to be up-to-the-minute market estimate of expected volatility for the S&P 500 index. And it's calculated from S&P 500 index options prices, specifically the SPX index. The VIX index is intended to provide an instantaneous measure of how much the market thinks the S&P will fluctuate over the next 30 days. Essentially, it's a 30-day forecast. And as such, the period the VIX covers is always rolling. So today's VIX price is a forecast of the anticipated volatility of the S&P from tomorrow, dealing with today's close, through Thursday, June 20th. And tomorrow's closing VIX will be a forecast through Friday, June 21st, and so on. Because the VIX index is just a rolling forecast, it isn't tradable itself, but there are listed products such as VIX futures and options on those futures. So I want to just talk about this a little bit because we often get questions about the VIX, and I'm not necessarily going to recommend a trade on the VIX today, although because of where the VIX is, we'll try to come up with a trade idea or a trade recommendation, and it pertains actually to one of the questions that we see here. But what I'm going to show first is just a long-term chart of the VIX index. So the one that I have up on my Bloomberg terminal screen right now, this is a 5-year history of the VIX index. And as you can see, here we are actually, it's still ticking a little bit. I have, and that's the reason it's still ticking is because SPX options actually close later than, the regular options. So regular options are closing at 4, these close at 4:15. And as it happens on this particular machine, I happen to get a delayed quote here. So this is actually going to remain ticking for a little bit. So it's just about 12:10. But let's just take a quick peek here and see, what we're looking at, just how historically low these levels are. So I'm just going to try to get a bar over here right around 12:10-ish. So we can go back. There we go. So right at 12:10, you can see that's approximately where we are right now. Has not reached these levels since 2019. And that period down here where you can see it was just a little bit lower, where it actually closed below 12, that was the 3 days preceding Thanksgiving. Now, an important thing to think about, because it's this rolling 30-day forecast, and it's just looking 30 calendar days out, if you have a number of non-trading weekdays in that period, then the overall volatility, you might expect it to be a little bit less. So for example, the next 30 days for us right now include Memorial Day, which is the markets are closed on Memorial Day. So part of the depressed level of the VIX, a very small part of it, is a function of the fact that you actually have 1 fewer trading days, which is one of the reasons that you often see lower VIX levels around Thanksgiving, Christmas, and New Year's, because you actually have a number of holidays or half trading days, and things tend to be a little bit quiet. Now, it should be said that when you have holidays or you have partial trading days, there is another element that can go into things, which is that you can have potentially slightly less liquidity in the market. So there could be circumstances that if a shock came in that instance, you could actually see volatility rise because of that lack of liquidity. But in general, it's a better bet that things are going to be quiet. The VIX is generally going to be a little bit lower if you incorporate a holiday. But that's not really, I think, the point that we want to think about when we see a VIX at a level like this. So it's sometimes described as the fear index, basically a measure of of how much complacency or concern there is by investors in the market. The fact is, and there's oftentimes people who look at the VIX and they think of it as a way to time the market also. They'll say, you know, if the VIX is very high, that might be a good time to buy the market because you are buying it when people are very fearful. And when it is very low, that's a time to sell the market because people are exceptionally greedy and complacent. And, you know, that could potentially signal that you're near a market top. I don't think that's the best way for people to think about it, because options prices are driven by options market makers who really care primarily about two factors. There are two driving factors to the price for options on any underlying instrument at any given time. The first is, because it incorporates a concept of volatility, is how volatile is the market itself. So that's sort of in a vacuum, that's the primary driver that observers should think about. So for that, we would actually take a look at the S&P and say, okay, well, how volatile is the S&P 500 here and now? So that's what we're looking at. I'm just going to get rid of this spread, and I'm going to get rid of this number as well. So this right here in orange represents the rolling 20-day realized volatility. Now, why am I looking at 20 days? Well, you can look at things as either 30 calendar days. In this case, this is just a measure of the actual trading days. And on any given month, you know, there's probably about 20, 22 trading days, depending on the length of the month. So this is really looking at 20 trading days worth of vol, or approximately just shy of one calendar month. And what we can see is that the realized volatility has actually been quite low of late. It's not as low over the last 20 days as it has been at some periods in the recent history. We can see, for example, right around Christmas at the tail end of last year, that volatility was actually lower, single digits at that time. But this is going to be an important driver for the VIX, number one. So how volatile is the market? So now I'm just shortening this up a little bit. In fact, actually, why don't we just take a look at this even, we can probably just look at this year to date. That'll just give us a sense of where things are. So we can see that the realized volatility for the S&P has actually been below 11 over the course of the last month or so. So that's the first driver. Something else that I've actually heard some folks on CNBC talking about it. I think Mandy Xu, who is, I can't remember, I think she was at Credit Suisse before, but she works for CBOE now, formerly known as the Chicago Board Options Exchange. CBOE, of course, is the exchange. VIX is a CBOE product. And I think I heard her responding to a question from somebody on CNBC about a week ago. And the question was, is the VIX artificially low because so many people are selling options premium to essentially generate some additional yield? So that speaks to the other potential driver for options premiums, which is, what is customer flow doing? If everybody is going out and they are buying options, market makers will continue to raise the price essentially until such time as demand to purchase them reverses and you see sellers. So continuous buying will drive prices for anything continuously higher up to a point, and then eventually, you know, as they often say, what's the cure for high prices? High prices. And then somebody will be tempted to come in and sell, and that can actually cause the prices to come in. So there is an impact that takes place that is a function of sort of the initiating flow or demand, essentially, for options. So the question was, is a lot of options selling the reason for a depressed VIX? And in fact, I don't think that's really the driving factor. I think realized volatility is low, and that's really the principal driver. So the next question we have to ask ourselves is, okay, well, why is realized volatility this low? Aren't there a lot of market concerns going on? And actually, we've seen some of these things happen. So over the course of this earnings season, we have seen some results that have been quite good. We've spoken about some of those things on this channel. We spoke about Walmart last week, which had very good results. The stock traded higher. We spoke about Starbucks, which had results a week earlier. Their results were poor. Market didn't like what they saw, and the stock traded significantly lower. We are about to have some very big results this week. I think we're getting Palo Alto Networks after the close today. We're going to have NVDA later this week, which is obviously one of the most important, probably, earnings results we're going to get. But what's interesting is that when you have stocks like Walmart going up and you have other stocks like Starbucks going down, you basically have these counteracting forces in the market, some which would elevate the index and others which would depress it. And what ends up happening is that when you have stocks moving in opposite directions, that even though they may be very volatile in and of themselves, the single stocks that is, the index may not be. And in fact, if they're moving in opposite directions, those counteracting forces can actually keep volatility at a low level. So the measurement that becomes important in that circumstance is not just the volatility of the individual constituent stocks of an index, which is, of course, very important, and the weight of those stocks in the index, which is also important. So if you take a look at a stock like Apple or NVIDIA or Amazon, Meta, Alphabet, all of the big stocks, they move the index more than small stocks do simply because they're larger components of it. But if they're moving in opposite directions, then the index itself may not move so much. So the measure that we also are, interested in is the correlation between these stocks. And that is also, as it turns out, something that options traders like to trade. Now, this gets a little bit wonky, but I think it's important in the sense that there is a way to think about if, when, and how you're going to hedge your portfolio based on this. So it turns out that the volatility of an index can be approximated by the weighted volatility of all of the individual stocks in that index and their respective, and the square root as it happens, of their respective correlations to one another. This all sounds very mathy, but the long and short of it is that if stocks all tend to behave the same way, then the index is going to be more volatile. And if they are not behaving at all the same way, so it's what many people will refer to as a stock picker's market. You'll sometimes hear that expression, a stock picker's market. You have to distinguish between the winners and losers. In a stock picker's market, you can begin to see the index get much, much quieter, even if the individual stocks within it aren't that quiet at all. And that's actually what is happening right now. So what would cause the VIX to rise? If we know that stocks like Starbucks are moving 20% to the downside and other stocks are moving sharply higher, what would cause the VIX to rise would be an increase in correlation, an increase in how much stocks tend to track together. Why is this important if you're not going to trade the VIX, which isn't what I'm going to recommend? It becomes important because when everyone enters a sort of a risk-off environment, so if we get anything that's going to cause real market concern, what will tend to happen? The discretion that investors are using right now to say, okay, I'm going to pick winners and I'm going to pick losers, becomes more of a general risk-off environment. People will often say that when you get into a risk-off environment, everything starts to go down, that correlation tends to rise. And in fact, we've actually seen this kind of thing. We actually saw the implied correlation, that is how much the options market's implied stocks would track together during the great financial crisis in late 2008. There was a moment when there was a bit of a disconnect in options prices, and if you looked at the prices of S&P options, and then you looked at the prices of all of the options for the single stocks within it, or at least the top 50 or 100 anyway, trading the really small constituents of it doesn't really matter that much. What we saw was that effectively stocks would have to be perfectly correlated to justify the price on the S&P options. Well, if stocks can be, correlation can only be for any two instruments, it has to be somewhere between -1 and 1. Things can be perfectly correlated, they could be perfectly anti-correlated, or they could be not at all correlated, which would be dead in the middle. But the point is that this actually sets up well for people who have portfolios, especially if you have a portfolio of stocks where you're long stocks, maybe you're selling covered calls on those stocks. When implied correlation, which is what we have right now, gets very, very low, you're actually in a good position to use some form of index options to hedge your portfolio against a downside move. So what we can do, and actually I'm just going to pull up, I guess SPY is probably the easiest thing, right? So SPY is the one of. The S&P 500 ETFs is probably the most well-known one. So what you end up finding is that the options on the ETF become very, very cheap. And more importantly, they are cheap relative to the options premiums on the single stocks within it. And so that's a situation that does set up well for folks who are selling premium against those single stocks to use these as a hedge. So that's what we're going to talk a little bit about right now. And actually, I think, you know what, I'm going to pop this question up because I saw this was one of the first questions we happened to get, and I think it's appropriate because that's really what we're here to talk about today. Question, good afternoon, Mike. What is your opinion on hedging with SPY considering the Fed meeting on June 11th and 12th? That question from Kirk Mazey or Mazzi. Please forgive me if I'm mispronouncing that. But it's a good question. I'm not sure. First of all, let's just talk a little bit about the June 11th, 12th meeting. We're going to get a little bit more inflation data before that happens. So PPI data came in, flat to hot. CPI data last week came in slightly lower than anticipated. And of course, that created a lot of optimism that we may actually still potentially get a rate cut at some point this year. I think it's unlikely that they announce that in June because I think they're probably going to want to have a couple data points in a row that suggest that they're getting to their target, and they're not to their target yet. What is the information that they're going to be looking to and that we should really pay attention to? PCE data, which is going to come out at the end of this month. I think that's important. I think maybe September would be a time frame when we could expect a cut if we're going to get one. If they get a couple, sequential positive data points on inflation, we might get something in that time frame. So how do you hedge using SPY? Well, as we just discussed, the VIX is, you can't trade the VIX, but it gives you a sense of where S&P 500 complex, and when I say the S&P 500 complex, I'm talking about SPX options, I'm talking about CME S&P 500 index, like the big futures contract options, SPY, IVV, you name it. Everything that's sort of, in that whole space. Those, when the VIX is low, then all else equal, the prices for short-dated options in that space are also going to be low. So what you would do is you could go out and buy some puts. So first I'm just going to get rid of, do that. So first things first, if you were looking out to what the Fed's comments are going to be, because I think it's going to be more comments than actual policy changes, but just knowing that that's a potential catalyst and one to keep an eye on, you could consider buying some, call it 30 delta puts, for example. That was, Goldman Sachs, that was sort of for a long time. I had a former colleague who worked at Goldman for a long time, and that was always kind of the ones that they looked to. It would strike a bit of a balance between keeping a relatively small amount of premium, giving yourself a little bit of convexity, and getting some kick. And when options premiums are very low, you'll notice that a 30 delta option won't be that far out of the money. So for June, that would be, in this case, based on the 530 or so closing price, that would be the 523 puts. Those would cost about $3.66 in premium. And so we can think about that a couple different ways. One way we could think about it is with respect to the share price of SPY. So that's 366 over 530. So you're going to be risking about just under 70 basis points. We'll call it 70 basis points to keep the math easy, of the current price of the underlying. And that's going to essentially kick in, instantaneously. And let's just show this a little bit like that. So you can see that instantaneously you're going to get this curve. So that's essentially what the P&L would look like tomorrow. If you bought these things today on the close and you wanted to know how is the behavior of this option going to look for changes in the underlying, it's going to behave a bit like that. And actually, I can, I believe, I don't know if I fired. Did I need to connect this? Let me see. I have to collect. I'm going to figure out how to connect that to the stream. But there was a step that I was supposed to follow, which I don't think I did. But the important point here is that $7 out of the money is 1.3%. And remember, you're spending 70 basis points of the current underlying to do it. So effectively, you've got 1-for-1 protection on SPY down 2% over the next 30 days. So that would be a very good way, I think, to hedge on going into that event. Now, something else to think about, which is that it's very tempting to simply just go out and buy those puts because they're relatively inexpensive. I understand that. The truth is that unless something really dramatic happens, extremely pronounced downdrafts in the market are really not that common. And one of the things I would just like to illustrate is that even as at-the-money implied volatility, so that's the price of options like this one, which are basically very close to the current underlying price, that out-of-the-money puts may indeed be considerably more expensive. People like to buy that out-of-the-money protection. There is also just greater jump risk to the downside in terms of price. So I'm just going to show what the price is here for these June options. Now, in this case, I'm using SPX options rather than SPY, but in effect, it's going to be essentially the same. So this is the skew. So this is basically the shape of implied volatilities for the S&P complex for that June expiration. And what you will observe is that, the 2% out of the money puts are a little bit more, look at that, about 12 implied vol, which is give or take right about where the VIX closed. And by the way, that's kind of a rule of thumb, is that 30 delta put out 30 days is probably going to have an implied volatility very close to where the VIX is. But what you can see is that if you go out 10% to the downside or something like that, that the implied volatility is much greater. So an alternative then to simply going out and buying that put would be that you could convert that into a spread. And when you do that, you're going to find yourself selling an option that you say, well, that option seems rather cheap as well. That's true, but the implied vol that you're collecting may indeed be very reasonable relative to relative to what you're buying. In fact, actually, why don't I just make this an even $10 just to keep it easy. All right. So here you're talking about $1.78 now instead of the $3.66. So you're essentially cutting the price of that trade in half. You're also going to cut down on the day-to-day decay. You will increase your probability of profit a little bit. I should point out that the probability of profit is not going to improve so dramatically when you're dealing with a situation like this, because the initial premium outlay for that put was low. The stock actually has to, in this case, the market has to decline by about 2%, give or take, to see profits. But this is a way that you can cut the price still further, and it does improve the math slightly. I will also say that what I will sometimes do and have done is put on a partial hedge, and then as and if the market does happen to move down, I might actually look to roll into the spread on those moves, either in whole or in part. So for example, if I had 5 SPX 30 delta puts on, and the market gives up a few points, and I have an opportunity to sell a couple lower strike ones, I might do that. So depending on what my view is at that moment, I might sell 2 or 3, or maybe go all the way out and end up selling the full 5 contracts of SPX against those puts to essentially get into that spread rather than doing it straight away. So that just gives you the ability to essentially trade around your position somewhat. So those are kind of my thoughts on it. I will say that one other important point, which is that some people like to look to the VIX to provide them as a trading signal. That is, that market's very complacent. I sort of alluded to this before. Therefore, the market's reaching a top. It's interesting. I've actually reviewed this in the history, and while it is certainly true that there are circumstances where we had some significant market disruptions that followed periods of very low implied volatility. For example, we saw that in what was called Volmageddon, which is when one of the exchange-traded products where people were shorting volatility blew up in early 2018. In late 2017, we had very, very compressed levels of volatility. The VIX was very low. I think we had the S&P trading at single digits, and we got this big shakeup. It is true that can happen. It is also true that the market also can do well for surprisingly long periods of times in low vol environments. So rather than trying to time a potential market top, I think the takeaway is that when you get into a situation like this, where implied vols on the S&P are very low relative to single stock, that this is actually just a good environment. Keep doing what you're doing, stay the course, stay long the stocks that you were in, continue to sell some premiums. Some of them are seeing some elevated premiums, which is good to collect. But this is your opportunity to hedge. When the VIX is 30, something like that, chances are that's not a great time to hedge. Chances are when you start seeing that, not only is it more expensive, but that also means that very likely the market has already sold off. So you're essentially going out and trying to buy some insurance when the house is already on fire, and that's just not going to be very effective. But I happen to think this is a very good time to have that trade set up in general, which is sell some upside premium, because I do feel like, boy, are we going to have a rocket to the moon types of moves? I don't know that that's necessarily the case. I think we see some valuations that are getting up there, but the whole trade sets up fairly well. In other words, that the premium on those single stocks should pay for index protection pretty effectively. Okay, so we have a question here from Ranjana Gupta. What are the considerations when trying to decide between buying a leap or buying the underlying stock outright? Well, for me, it's actually just a question of vol, right? So am I significantly overpaying relative to not only where volatility has been, because when you buy a leap option, well, let's just say you're buying a leap call option, and that's obviously what you're talking about because you're talking about buying a leap rather than the stock, so it wouldn't be a put. The question is, are you getting good value for money? The first question, of course, am I getting good value for money with the underlying stock? But your question presumes that you've already made that determination. And why don't we take a look at a stock as an example? I mean, we could start with perhaps something like NVDA that's coming up. So here's a chart of, you know what, I know that some of you prefer candle charts, so let me just make sure that I'm using a candle chart. And maybe I'm just going to look at its performance so far year to date. Okay. So stock is trundling right around its all-time highs. It's a little off of them. We obviously got up to 974-ish, but we're not far off of the all-time highs. Got some news coming out in the form of earnings day after tomorrow, I believe. Today's the 20th, just making sure. So after the close on Wednesday. And so the question becomes, if you own the stock, would you rather own a call option? Well, in one sense, at a certain price, of course you would, because we're dealing with a stock that is up very sharply, that is trading at heady valuations. And by the way, when I say heady valuations, I don't mean that it's overpriced. Whether it's overpriced is something we're only going to know with the benefit of hindsight once we see how good their operating results are. When I say heady valuations, what I mean is that the stock is priced for tremendous success, which a lot of people anticipated. And by the way, I think it was Dan Niles. I'm just going to read a quote from him that he said in advance of that. But he said, I expect, and this is a direct quote, I expect a large beat and raise when NVIDIA results are released, given more supply available from Taiwan Semi, given the stock is trading 15% below its 5-year average forward price to earnings multiple, but expectations are extremely high. He put the extremely in all caps. I would expect a small positive reaction from the stock. Just adding a little bit more. If I compare the surge in spending on AI today to that of the internet in its early days, from the launch of ChatGPT in late 22 through Q1 of 24, it has been roughly 5 quarters. NVIDIA, the enabler of generative AI, is expected to see its revenues increase over 4-fold from $6 billion, that was for the quarter ended in October of 22, to an estimated $25 billion for their soon-to-be reported Q1. So it's a tremendous growth story. That is priced into the stock, and so one could understand why you would want to belong it, but if you buy a call, you have upside participation, but not the same amount of downside risk. That's why it's synthetically equivalent to owning the stock and buying a put to hedge. Well, the question that we're asking about whether you want to buy a leap or buy the stock is, how expensive is that hedge? Well, why don't we take a look at some leaps in NVIDIA to make that determination. So I'm just going to pull it up over here now. And we're going to go out and take a look at a long-dated call option. So I'll go out to, I could go out to January 2025, but I could go even a little further. Let's go out a full, when I think about leaps, I'm usually thinking about options that are at least a year away. So in that case, that would take us out to June at a minimum. So basically a little over a year away. All right, so stocks trading 950-ish, round numbers. What does a June 950 call cost? Well, that option right now costs, the mid-market price for that is $207 a contract, $207.55. So that works out to almost 22% of the current stock price. That's an expensive hedge, right? So If that was 10%, I think we could all reasonably say, now maybe we could just pull up this candle chart that I had here before on the Bloomberg here. So we can see that even within recent history, the stock was in the high 700s right here. And we can see that it was in the high 900s, up to 974 was actually the all-time high here. So that's a pretty big range. So if we say, well, reasonably the stock could trade between 780 and 980 over the course of just a month or so, that's a $200 range. So depending on how you look at it, you could say, well, the stock traded in a $200 range over the course of the last month, a little more actually, last 2 months. Well, if it could trade in a range like that, then that's a reasonable price to pay for insurance. On the other hand, if your expectation is that you're going to make 20, 30, 40% on the stock over the course of the next year, it needs to move at least 22% to even see profits in this case. So if it stays right here, you're going to lose 22%. It would need to decline more than 22% from its current price before you would find that justifiable. So another way to do it then, and a way that I've seen a lot of people talk about it, is that they will instead say, okay, well, I don't want to spend so much extrinsic premium. So I would rather buy an in-the-money call option and therefore lay out considerably less extrinsic premium than I might be paying otherwise. So you'll notice that I can go from the 950 calls, which cost $207, I can choose a call option that is $150 lower strike, so actually in the money now, and that option's $282. So let's just think about that for a second. So 282, I'm just going to round the other one up to 208. So that's about 35% more to buy a call option that's $150 more in, this one's actually $150 in the money. So the extrinsic premium now is $130. So now your standstill rate of return is going to be that 130 over 950. So you're going to pay about 13.7%. To me, this all seems quite expensive, right? So I'm not terribly interested in a situation like that where you're looking at a straddle. So the straddle on NVIDIA in this case is, call it 40, 44, 45% of the stock price. That's a big, big range for the stock to trade in over that time frame. So what you're looking for actually are circumstances where you can buy long-dated options and it's not really at a huge premium. So let's go back to SPY for just a second and see what that looks like, because this is a circumstance. Now, longer dated options in most underlyings, but this is typically true for the S&P as well, they will typically trade at a higher implied volatility than the nearer dated options will. So for single stocks, you might see something going on, right around an event like NVIDIA. We're going to see that in a second. But what you're going to find in something like SPY is that those long dated options are actually going to be probably quite cheap. And so we can just take a look. I'll just go out to the Junes again now. So see the at the money options. So we were looking at the 530s. Now you can see that you're buying those at the money call options. These are 46.41. So remember the NVIDIA call options at the money were 22% of the value of the underlying versus 8.7% for SPY. And that's going to be just partially a function of the fact that, of course, SPY is less volatile, but and this would even be cheaper still if it weren't for the fact that the term structure is pretty steeply upward sloping. I will say though one final thing, and this actually goes to Palo Alto Networks as well, because I wrote an article about this. But if you're using calendar spreads so that you're offsetting some of the extrinsic premium that you're spending for those longer dated options by selling nearer dated stuff that is very pricey, that's a trade that I'm actually okay with. And actually, let's take a look at that. I think I believe I discussed this. Some of you can remind me. I think I talked about NVIDIA last week, and we talked a little bit about a strangle swap. So let's just take a quick peek and see what the implied move is right now for NVIDIA going into earnings. So the implied move is 8.6%, which is below the long-term average of 7%, but not hugely expensive given that 3 of the last 5 earnings have seen one-day moves in the double digits. So Q4 23, stock rose 14%. Q1 24, up 24%. The next 2 quarters were pretty quiet. And then last quarter, when they reported their Q4 24 results in February on the 21st after the close, the next day the stock moved 16.4%. So those are some pretty big moves. You know, we can see things have quieted down a little bit, but what would a trade like, like I said, I think I talked about this a little bit. Let's just talk about that implied move, 1.09. So just taking the stock up by that amount gets us up. I think I was looking at the 10, if memory served, I was looking at the 1020. Stock's a little bit higher now than it was. So you'd be looking at maybe the 1030 calls. I would want these to capture the next earnings if I could. August won't do it because the next reported quarter, so they're going to report on Wednesday, and then the estimated report date for NVIDIA after that, so when they're going to be reporting their Q2 25 results, is third week of August. August expiration falls in the teens, so August expiration won't grab it. So we would take the September 1030s, sell these near dated options, same strike. This would be the call spread component. And you could do this with leaps, by the way, if you were interested in doing that. And then you would do something similar on the put side. So go once again out to September, try to capture, so we'll say monitor, maybe 860. Well, let's see what strikes we have here. Probably these are going to be $10 strikes, so that's going to be maybe the 860s. Then sell some of these against it, and let's see how much premium you're actually collecting for that trade. Oops, I did not do that correctly, did I? So buying sub, so. Oh no, that's right. Okay, so now this is a very high dollar stock and it's very high premium options. So this is not a trade for somebody who doesn't have a decent amount of money to put into premium, because you can see that just one of these strangle swaps is going to be an outlay of about $11,400, give or take. But it has this sort of break even and return profile. And one of the things I always point out about these is that they just sort of naturally, there's more vega, there's more premium to that upside strike. So they just tend to have sort of a positive bias. And actually, that's probably not surprising in general. I mean, if you're going to sell premium, you probably have a bullish to mildly bullish tilt. When you have big disappointments like the one that we got in Starbucks, like the one that we got, whatever it was, 6 weeks ago or so in Foot Locker, those types of circumstances are not ones usually that great for selling premium. And actually, I did a trade just like this for those of you who are watching it. In Foot Locker, we got the direction right, managed to escape for a push because the downside move actually was much bigger than I'd anticipated, and I did a put calendar in that case. So you want it to run to the short strike, but not run well through it, and that's what happened to me in that case. But you get a trade a bit like this. So, with respect to buying leaps, another quick thing, I think this is very important, and that is that and this is not as true for NVIDIA as it would be for, let's say you have an IPO. When a stock first begins trading, it tends to be much more volatile than it will be in the long run. People are waiting to see, a couple quarters worth of operating results. Things sort of have to sort themselves out. So oftentimes what will happen is that the premiums for options will just sort of steadily fall after that release. I did a study where I was looking at all of the IPOs over a decade's period, and there was definitely a trend that over the course of time, the volatility of the stock and the implied volatility of the options would fall. So there's another circumstance where buying leaps right off the bat is probably not a good idea, because you're going to end up overpaying. The stock is going to quiet down, the options premiums are going to come in, and then once you sort of get to some sort of stasis, then I think it's more reasonable. But oftentimes when you have things that are chopping around, you can end up overpaying for those leaps. So I hope that helps you. Okay. Can you please walk through your strangle trade on Palo Alto Networks that you shared through CNBC today? Oh yeah, sure. So that's, again, similar situation. I like these kinds of trades. And actually, let me pull up Palo Alto Networks over here on the Bloomberg terminal first. I just want you guys to see, what it is that I was kind of looking at first. So I'm going to get rid of the historical volatility for just a moment and just take a look at sort of a longer term trend for options premiums. Okay. So, what I'm looking at here is just the general price of options. And if longer dated options, here I'm looking at 3-month options. If longer dated options are towards the upper end of the range, these types of trades don't set up as well. And actually, I can just show you some statistics here. You can see that you were right around the mean level, right? So if you're looking over here on the right, we can see that at the money implied, about 39%. The mean's about 37.5%. So it's kind of right in that neighborhood. This trade, buying longer dated options, would be an even better setup if it was towards the lower end of that range and we thought that there could be a big move coming out of the results. But I think it was a similar trade. And actually, let me just quickly look up those strikes if I can find it. If you had included that in your question, then I wouldn't have to look up what I had done there. But give me one moment while I look this up. So that was, what strikes did I have when I did that? So that was the, okay, yeah, and this was the, again, it was the weeklies, so it was a very similar structure. So we're just going to go here, and I was again looking out to September. These were the, now sometimes you'll see the situation where longer dated options, they have higher dollar stocks. This has $10 strikes. So we're going to just buy both of these in this case. This was the 280, 350. So I'm just going to buy the 350 calls here, buy the 280 puts. And that's because this doesn't have 285 strikes. And then I'm just going to, again, another strangle swap, trying to take advantage of the fact that the near dated options are, elevated in terms of premium. What defines elevated? I think that's also an important thing to think about, and that is, what are the options markets implying the move could be relative to its own history? In a situation where, and I actually used the 285s because I wanted to collect at least $2 for these options, and so you end up with this trade right here. And you can see what these break-evens are, right? So the break-evens are theoretically, down here around, call it 275, and up here around 390-ish. Now, an important point, these break-evens aren't necessarily assuming the appropriate amount of vol crush coming out of the event. So I would probably just take a look at that P&L curve and shift the whole thing down. And you'll notice that if you shift that curve down, you're also going to bring those break-evens in, as well as reducing the amount of profit that you would be making inside of this range. But when you get pretty good size implied moves, this is just a trade structure I happen to like. Also on some of these, high dollar stocks, sometimes you can sort of define your risk and play for that. I'm not always playing for that type of move. And by the way, imagine if one had done this type of a trade on Starbucks. Now, as it happened, Starbucks was not implying a big move, so this trade didn't set up that well. And then you got a huge move, so it would have been a complete disaster. So that just to understand when this works and when it doesn't. It works when the options market is implying a very large move for a potential catalyst, and where you believe that the move is not likely to exceed that range. When you have situations where there's not a very big implied move, the amount of available profit in a trade like that is going to be relatively small, and the risk is great. And very often this is going to be the case in the options world, that these two things are inversely related. So important point, consideration there. Okay. So hopefully that helps you on Palo Alto. Let me just pull that. I'm just going to show you that trade once again so you can sort of see it here. So that was the September 280, 350 strangle, buying the put and the call, and the May 24th weekly, that's expiring this Friday, selling the 285, 350 strangle. Okay. Mike, what are your thoughts on Target in earnings? So I have a couple thoughts on Target. Target, by the way, if anybody was paying any attention, Target got pretty hard hit today. So they're going to be reporting earnings. What was the cause of this decline we saw today, which, as you can see, was about 2%. So the company announced today that they are going to be reducing prices on a really large number of items. I want to say something like 5,000 SKUs or something like that. The rationale for this was that they wanted to, quote, be more competitive, unquote. When they say more competitive, I think we need to assume that they are talking about Walmart, most likely, right? So slightly different demographic, not really, they're comparable companies, but they're not identical competitors. And I would actually say that there's a bigger spread between Target and Walmart than there is between, for example, Home Depot and Lowe's. Home Depot and Lowe's are very similar types of stores. Home Depot has a different customer focus. 40% of Home Depot's customers are professionals, contractors, and I think it's about 3% or some similarly small number at Lowe's. Target stores have a much smaller footprint. Historically, maybe it was slightly more upscale, I would say, than Walmart. Walmart has a couple big advantages that they've got going on right now. Their e-commerce group is doing quite well. In fact, it actually saw double-digit growth. They just reported, as I'm sure you all know, numbers were solid, 6% top line growth. There was a small inflation adjustment that you needed to make. They intimated that it was about a 40 basis point increase in prices. If you adjust for inflation, that took it down to about 5.8. And I'm talking about all segments, so that includes e-commerce and the retail sales, domestic and international. And then if you account for the extra selling day within the quarter, because it's a leap year, so that was about another 1%. So you figure that it was about 4.8% year over year top line growth for Walmart, and they ended up beating even the high end of the range. So the EPS range forecast for Walmart was between 51 and 58 cents, if my memory serves me correctly, with a mean around 52.5, and they reported 62. So good numbers from them. So a little bump on the margin side, and the e-commerce side was growing. I find the timing on the Target price cuts curious. It makes me wonder whether their foot traffic and sales numbers didn't grow at the same pace as Walmart's did. And we're about to find out because they're going to be reporting. The flip side of that is that Target is trading at a discount relative to Walmart. So right now we're looking at, let's take a look at what their price to forward earnings. You know, we care more, but just an important reminder, we always care more about the price to forward earnings than trailing. Don't want to go running down the highway driving only by looking in your rearview mirror. So it's really the forward number that we care about. 16.6, is that the number? It's in that, yeah, what is that? Just can't quite make it a, that's, yeah, about 16 and a half. So 16 and a half times forward earnings, and we're looking, what's the street looking for? 952 for full year, and for this upcoming quarter, they're hoping for 205. That would be a sequential decline, actually. Just confirm that over here. Yeah, looking for just under 205 a share. And yeah, I found the price, I did find these price cuts that they announced today interesting. Couple, you know, for two reasons. One, lower prices, all else equal, lower margins. So when they're going to lower prices, it does make you say, okay, well, if you were baking certain margin assumptions into your models and they're going to be cutting prices, then those margin assumptions were probably ambitious. The forecast for full year margins was 4.1%. In recent years, we've seen them get as low as 2.6 to 3.9%. And so that could be potentially material. And like I said, the timing, I find that to be a little curious as well. Now, they did resolve some of their inventory issues, and they had, so Target had a little bit of controversy a while ago. You know, not going to get into a big debate about the merits of their product choices, but there were some people calling for boycotts for some products that they were offering a year ago. I think that has largely blown over by now, and I'm not terribly concerned about that. I would like to see them do some of the same things that Walmart has done, which is sort of improve and expand what they're doing on the grocery side, because groceries, perishable as they are, tend to get recurring foot traffic in the door, and then hopefully you get a little discretionary spending at the same time. I think that's a strength that Walmart has, and of course it would be great to see some uptick on the e-commerce side as well. Options market right now implying a move of about 7% for Target, and that's probably very reasonable given the kinds of moves it's seen recently. I mean, the most recent two reported quarters, we saw moves of almost 18% and 12% respectively. So if we just take a look at the history, I think that's, you know, that's fine. What I would, in terms of what it's implying, what I would be, you know, I'm cautiously optimistic, but I don't like the news we just saw. We did get a pretty strong down day today. So because of that, if you're going to make sort of a cautious bet, one thing you could do is look to potentially trade a diagonal call spread going into the event. So then you would buy a longer dated call and then sell something a little nearer dated against it. I mean, could be the weekly, but I don't know how much premium we're going to get into those. Take a look here. Get a structure that looks a little bit like this. So just using that near dated call to offset some of the vol crush that you might get. I don't know that this is quite appealing enough, though. I might want to go out a little bit further because I would like to get, at least a quarter of the premium that I'm spending for that longer dated option, if I can. Still preserve some upside. By using a diagonal, the nice thing about using a diagonal in a situation like this is that you don't have a break even on the upside. There is no price, as long as you spend less than the difference between the two strikes that you're trading. So in this case, $10. As long as you lay out less premium than that, you can't lose to the upside. You can only lose to the downside. And it has to, move down, probably by about the implied move or so, and to see all of those, that premium wiped out. But in this case, you're looking at, 760 over. Yeah, so you're looking at less than 5% of the current stock price that you'd be risking on a trade like this one. So that would be a way to play it. I actually was positive on Target up until I saw this news today about these price cuts. And it's just the timing that has me a little bit uneasy, I have to say. Why are they announcing these price cuts right now? I mean, you're about to report. So a little uneasy about that, but I'm still positive on it overall. Okay, so let's see what we've got here. Where are we? So we talked about. So Elizabeth was just asking about NVIDIA. I think maybe I answered that question with that strangle swap idea. But if that was not enough clarification, we can come back to that. What are your thoughts on using delta for determining expected limits? For example, your NVIDIA strangle swap on CNBC, delta were 18 and 22 respectively. Yeah, so it's interesting. The delta is actually, that's a fine way to choose it if you would like to. Those deltas are actually going to correspond. I was talking about the implied move. So let's think about this for a second. The implied move is going to be less than one standard deviation. So if you can imagine that one standard deviation is going to encompass about 68% of the anticipated outcomes between now and the target date. So what that would tell you, let's round it up and call it 70. Again, I like to do that just to keep the math easy. And let's just say that you were trying to assign equal probabilities to the calls and the puts that you were using for your trade. Well, if you're talking about 70% probability within those boundaries for one standard deviation, then you would be talking about 15 delta call and a 15 delta put. The implied move for a normal distribution is about 80% of the standard deviation. And as it happens, that brings that into about a 60% chance. So now you are dealing with about 20 and 20 in terms of your deltas. And the probability of profit will still be close to 70% on that trade. And the reason is because the boundary of profitability on that trade is not at the strikes, but slightly beyond it. So if I use the implied move, or 80% of the standard deviation to identify my strikes, then my probability of profit is still going to be about 70% because I can violate them a little bit on the high side and the low side and still be okay. So if you're using 20 deltas for the call and the put, you're in that ballpark. So yeah, I think that's fine. Okay, so what do we have here? That was okay. So somebody's also asking about the Palo Alto. Oh, I seem to be getting lots of questions about the strangle swap. So hopefully that helps. Okay. When do you think the SPX could fall back below 5,000? Well, probably most of you who watch me a decent amount know that I try to shy away from short-term predictions for what the market's going to do. I don't have any unique insights as to, I don't have a crystal ball. Wish I did. I'm more interested in valuations, and then I'm interested in how options sort of set up with respect to those valuations. If you think about, what we're talking about here isn't value investing, so I want to be clear about that. But many of you will know that I often sort of like to take a value investor's approach to things. And value investors, I worked for a hedge fund that had a deep dive fundamental analysis approach. And the perspective was kind of more of a private equity kind of an approach, actually, which is, go try to find an attractive looking business, sort of bottom up fundamental analysis, and see if you can buy that business at an attractive price. It was a long short fund, so that once you did that, you were then supposed to go out and try to find one that was not as attractively priced and sell it against it. But my point is that, we didn't really assume that we had unique insights as to what the market might do and when. And so consequently, we weren't really making a lot of forecasts in that area. I will say also that I am still interested, of course, as everybody is, in what short-term price action could look like. And, the VIX, as I pointed out, some people think that a low VIX is a contrary indicator and you should be a seller. But I'm not, we don't necessarily see a lot of evidence that that's true. Oftentimes the market can get some very good results when vol is low. It's just the market environment that you're in. 1999, for example, had a period of very sharp market increases, much like the ones that we have seen recently. And of course, that was a market bubble. But the market bubble continued to inflate for another year before it came undone. So even if we think that valuations are slightly elevated here, it doesn't mean that they can't become more so. So right here, what I've pulled up, this little table, and I don't know if we can zoom in on it a little bit. All I'm taking a look at here are the technical indicators that have performed best for the S&P going back over the last year or so. And they're ranked basically from the best performing to the worst. And you're going to notice something, and what you're going to notice is that of all of those indicators, let's exclude buy and hold. I mean, buy and hold is just an investment approach. But what you'll observe is that of all of the technical indicators, the short-term technical indicators that have actually performed reasonably well over the course of the last year, all but two would be long here, right? And the best performing of those is the weighted moving average. That's this one. We can see where those indicators are. It was a buyer right here. It was triggered on, what day was that? On the 6th of May. So it was a buyer here and a seller there. This was just using the weighted moving average, just the 50-day weighted moving average. And, so far, so good. So, I think that my attitude about it is, we stay long and we be long until such time as we get some sort of a break, in essence. We haven't had that yet. Oops. Wow. Time has elapsed. And I actually have to go on CNBC. So for those of you who decided to watch me here and provide some questions, as always, I really appreciate your time and attention, and I really appreciate the interaction. There's a couple more questions in here, and hopefully we can get to those or some others on Wednesday at 4:15, and I hope you join me here for that. Thanks for watching.